Hello, I'm Robin Gibson, and this is the Harvard House Money Morsel. Welcome back. Thank you for joining us again. Don't forget to like and subscribe. Click the bell so you get a notification of when we're releasing a new video. I'm sitting together with Michael Porter again on a very frosty and cold morning.
Sure, it is
in
the
Midlands.
coldest morning of the winter so far.
Easily,
I think, Robin.
yes, yeah, easily, Michael. So, Michael, what isn't frosty is the Strait of Hormuz, and oil does seem to be moving around, and we've seen oil absolutely plummet. So, can you tell us what's going on out there?
Yeah, Robin, I was just writing Intuition last week and saying that a week is a long time in politics. There's that old saying, but it's actually applies to markets too.
Yes.
A lot can change in a week or a couple of weeks. And in our presentation, we actually laid out that we thought even if the Strait reopened, that oil prices would remain around about $100 a barrel for the rest of the year because of supply and demand, restocking, ships being in the wrong places, and everything like that. That hasn't been the case. I mean, oil prices are close to $70 a barrel, which is fantastic. And really, I suppose when we delve into it, what seems to have happened is that that demand has been curtailed quite a lot. People have cut back on demand for oil a lot, and the oil market just it's not in as much stress as we thought it would be, So yeah, it's really exciting. I mean, from a consumer point of view, oil prices are right down. The rand is really well behaved, 16.25 to the dollar at the moment. The rand price of oil is about 1,180 rand a barrel. Mm-hmm. It reached a low point of about 980 in January, but the day before the war started, it was about 1,200. So, we're basically back at where we were before the war started. There was an uptick in oil prices in February, I suppose, in anticipation a little bit of the war. We saw petrol prices come down last week, Robin. But if the rand stays where it is, and if oil prices stay where they are for the whole of July, we're going to see another substantial drop in petrol prices in the 1st of August.
So, Michael, we always bring this back to inflation and interest rates. So, has that picture now changed? Are we looking at a different scenario? How does that look?
Yeah, it's interesting, Robin, because if you look at South Africa, the market immediately started pricing no more rate hikes, and our Reserve Bank meets later this month in July, and so we'll get a sense of that. It's a little bit harder on our side, I think, to judge whether the Reserve Bank will hike rates or not. Yes, the inflation is going to be hopefully a short little hill that hopefully will come down. And if you think about where oil prices are at the moment, this is where the rand price of oil was July, August, September last year. So if you're looking year on year, it's no different to where it was a year ago. And that's obviously where the time frame over which inflation is sort of measured, So from that point of view, it's quite positive. I think the challenge on our Reserve Bank is that they are trying to move to a lower target. So they are going to be concerned that they don't want those inflation expectations to get embedded. So whether they hike again or not is a tough call. It's probably 50-50. I don't think they need to. And I think we've often talked about the fact that our Reserve Bank is too conservative and whether we should even have a 3% inflation target in a country like ours. Are we going to have high interest rates for a long period just because the Reserve Bank is too aggressive on inflation, But that's a debate for a whole other day.
No, exactly.
If we move across to the US, it's a bit more interesting because, Kevin Walsh is the new chairman of the Federal Reserve. He's been appointed by Trump. Everybody thought that he would come in and do Trump's bidding and cut interest rates, and he's actually turned out to be quite hawkish. And they had a meeting a couple of weeks ago, about a month ago, and it was kind of, we're hiking rates, and the dollar's strong, commodity prices have collapsed on the back of that. Yesterday we had, last week we had employment numbers in the US. They were soft. The market's now dialing back those expectations and saying, actually, maybe we won't have an interest rate hike in the US. So the dollar weakened a bit, commodity prices have rallied, and I think one of the challenges, Robin, for investors is that the momentum trade makes people run from one side of the ship to the other. The momentum pushes it all that way, and whether that's because of ETFs and passive, who knows? But then the momentum changes and everybody goes shooting across the other way. And so actually, as long-term investors, I think you actually have to quite consciously try and step back from a little bit of the noise and focus on some of the bigger goals. Because if you chase momentum all day, A, you're going to get tired,
Yes.
and B, you're going to slip, you know, if you think about a rolling ship.
No,
you know.
absolutely.
Yeah.
And Michael, I mean, talking about running from one side to the other, it does appear that quite a bit of the froth is coming out of the AI related market, isn't it?
Yeah. Is that the frost or the froth?
Oh,
Both.
Yeah. Frost there, froth
Yeah,
here.
you know, the whole trade this year, Robin, is on AI has been the picks and shovels and the AI race. All the chip manufacturers, you look at all the big chip manufacturers in Taiwan and South Korea, the ASMLs, you know, in the US as well. Intel, I mean, Intel's what, 200% up this year or something ridiculous like that, you know. And it's been a really, it's been just non-stop, that kind of whole market. And the big hyperscalers like Amazon, Google, Microsoft, who are building the data centers and monetizing AI, have not performed well at all this year, you know. That seems to be changing a little bit as well. I think there's one or two comments, you know, some of the big hyperscalers are, well, we're renting out space and they're trying to monetize all this capital that they investing, which is exactly the right thing to do because they're spending a lot of money, so you want to get a return on that money. But I think it's just forcing, you know, maybe some of the expectations about how much is going to be rolled out and the pace of all this capex is just being dialed back a little bit, you know, and so some of the froth is coming out of that. I think it's a very good thing. The S&P is up 10% this year, Robin. Pretty solid return from the S&P, but if you strip out the semiconductor sector, which includes NVIDIA, there's about 15 or 20 shares in that semiconductor sector out of 500. The S&P is up about 3%.
Okay.
You know, and so, yeah, the US market isn't as strong as it looks from the outside when you strip out one or two key sectors that are just driving the whole market higher. And I know when you look at markets, you can apply that to a lot of things, but actually, generally, I think markets are, yeah, you know, the war has taken its toll a little bit, you know. Yeah.
Awesome. Well, Michael, thank you for giving us an insight into that. Whatever you do, don't run to the wrong side of the ship, and make sure that you are a long-term investor. Thank you for joining us. Thank you for giving us the insights. Don't forget to like and subscribe. We'll catch you next time. Bye-bye.